Hello and welcome. This is BQ Prime. I am Agam Vakil, and we are taking stock of all that is happening globally, especially given what we have seen from the Federal Reserve overnight. Well, to take us through, understand what we've seen, what the Federal Reserve means, and the implications that it may have on markets, specifically in Asia, perhaps, we have with us Audrey Go. She is the head of asset allocation and thematic strategy, a wealth management group with Standard Chartered. Well, Audrey, good morning and thanks so much for joining in. I'm just going to straight up start with the Federal Reserve. We know that the rates were kept unchanged, but we also have a relatively hawkish Federal Reserve chairman talking to us. What do you make of the commentary and what's the road ahead?
Well, thanks for having me, and good morning, everybody. So the Federal Reserve Fed Chair Powell basically kept interest rate unchanged at the overnight policy meeting. And if you look at the statement, in fact, the statement was largely the same from the prior month. I think what's more interesting is the significant revision that we have seen to their dot plot, which is their economic and interest rates forecast expectation. So if you look at how they have tweaked their forecast, they have in fact revised up growth stronger. So this is growth of originally about 1%, but they've revised it to just over 2%. And then from a labor market perspective as well, they've also revised it lower in terms of unemployment rate, where unemployment rate has been revised down to 3.8% from 4.1% initially. And I think that's in part due to the very strong or rather resilience that we have seen among consumer, which continue to drive consumption as well as keeping the wage or keeping the labor market very, very healthy. And I think more importantly, in terms of their forecast, is also their expectations in terms of inflation. So we have seen both headline inflation and core inflation creeping lower since June last year. And in fact, in this current estimates by the Federal Reserve as well, they've also revised down the core PCE down to about 3.7% from over 4% this year, but they've kept the 2024 expectations largely unchanged. So I think net, I would say a hawkish pause, but it's not all bad because I think it could be quite constructive when it comes to bond investors, given our expectation that we're probably quite close to the peak of the Fed hiking cycle for now.
Right. Audrey, I'm going to talk about equity specifically. Firstly, when it comes to developed markets against emerging markets, where would your allocation be? How would your allocation be? And how do you see these markets develop and move perhaps over the course of the next year?
So for now, we have a slight preference in terms of where developed markets are concerned. Namely, we are overweight on the US as well as Japanese equities. I think US are quite key, which is the resilience of its consumer, which we are still continuing to see as of today, even after 5.25% of rate hikes over the last 18 months or so. So that's one key area that we like, and we believe that there is still some momentum, at least until the end of the year, before we start to see weaker data feeding through into concerns over corporate earnings. The other area we like in developed market is Japanese equities. I think this is one bright spot among global equities today because unlike many of the other equity region, Japan actually is one key country which really wants to get its inflation higher so that it can emerge from the last 30 years of deflationary environment that it has been. And if it is successful in doing so, what that means is we should then start to see higher nominal growth feeding into higher revenue and eventually corporate profitability as well. And that should really help Japanese equities to outperform the other key regional equities. And then when it comes to emerging markets, I think really China is the big elephant in the room, right? Because so far economic growth has been quite lackluster from the beginning of the year to now. Obviously, we have seen some small signs of stabilization in August activity data, but there is still some sense that policymakers will need to do a lot more versus the piecemeal stimulus that we have seen coming through over the last couple of months. So net from an Asia perspective, we are largely neutral.
Right, Audrey. Also, when it comes to developed markets, how would your allocation be ideally between debt and equity?
Okay, so in this case, from a developed market perspective, we have a roughly balanced allocation, maybe slightly more tilt towards equity market in our moderate or balanced model portfolio. And I think if we think about it, both actually have panned out quite well for us because when I look at our balanced portfolio today, it is up, say, circa about 7%, which obviously lagged the robust performance that we've seen in, say, equities market, but certainly outperforming what we've seen in bonds, largely speaking. So we are slightly balanced here, and obviously we will take quite a data-dependent approach, given that we are at this part of the business cycle where we might either be transitioning to a lower growth and potentially even a recession, which is our base case for the US. We have a 55% probability of a US recession by the first half of the year. But again, if you look at the probability, it's almost like a flip of a coin as well, which is why from an allocation perspective, we keep a largely balanced allocation between both asset classes.
Right. Then to shift focus towards Asian markets, how do you rate some of your larger economies like China and compare it to India in terms of fund flows, your expectations, how valuations in these markets are, what's the way forward? And in this case, I'm talking specifically about equities.
Okay, so I think India is a market where we have a structurally bullish view on. So for any if there is any significant pullback in the Indian Nifty, for example, we'll be keen to use that opportunity to average in, because I think there's a few good structural drivers going on for India. For example, the reforms that the country has undertaken to make the countries more attractive to, say, manufacturers to house their sourcing activity over here. Also, the fact that the rupee is a lot more stable as well compared to in the past. And I think, above all, if you think about it, the ongoing geopolitical tension between China and largely the Western part of the world also meant that other markets, for example, India, will stand to benefit as companies think about making their supply chain more resilient by relocating some of their existing manufacturing facilities, say from China to India. So India is one area that we like. Obviously, the valuation has always been quite high. And I think in the near term, the spike in food inflation is probably also a concern. But having said that, it is one market that will be happy to average in on it. So that's for India. And then for China, I think we have a rather lukewarm view, if you think about it, because I think there is a few things which are, if we look at the key pillars of growth in China, there's property, there's export, and of course, there's a domestic consumption, which are key drivers to Chinese growth. And two out of the three pillars are quite weak, I would say, because we know, as we all know, the property market prices has been falling, and the confidence of homeowners or home buyers are very, very low after a recent spate of, say, defaults by property developers. So that in itself is likely not going to be a strong sort of a driver for growth in the next 6 to 12 months. If you look at exports, again, the trade tension with developed markets, namely the US, also will weigh on exports as well. So even though we have seen significant some decline in the yuan renminbi, that has not really translated to robust export growth, which historically, say back in 2000s, has been a very, very strong growth driver. And if you look at domestic consumption, that has been the one holding up China's growth. But again, it's a bit more lukewarm than expected. Also because I think people are a bit more adverse at the moment, given home prices are falling and they just came out of COVID, and they didn't really get that much of a stimulus check as what consumers have gotten, say, in the West. So net from these three pillar perspective, I think we have a rather benign view when it comes to China. So overall, a neutral allocation.
Audrey, go. We'll leave it at that. Thank you so much for joining us and taking us through your views on the global markets. But with that, it's a wrap on this view, or as far as the global markets are concerned. But there's lots more lined up on BQ Prime, so stay tuned and we'll keep bringing you more.